Good afternoon, everyone. Welcome to today's Wednesday market review. My name is stockdarts, and as usual, we're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish with that, we will take a quick look at the US dollar, see how it's behaving, see how it's affecting gold and silver. Today's going to be an interesting day. We have FOMC, and I expect a lot of movement coming out of the US dollar and probably out of the stock market as well, but we'll get into that in a minute. If you like what you see here, you like the way I analyze the markets, then feel free to follow me at stockdarts. Feel free to follow me at YouTube under the same name, stockdarts, or you could visit me at patreon.com/stockdarts, where I post trade ideas and my general thoughts on the market a couple times a week or 3 times a week, as well as any recordings of these Wednesday market reviews. Other than that, let's go ahead and get started, and let's take a look at the S&P 500. Like I said, we have FOMC today. It's widely expected that they're going to cut rates, which should have a positive effect on the market unless it's a sell the news event, and we've been expecting it. I imagine we've been expecting it, and so it's probably not going to come as a shock, and I think it's probably going to come down to what they say after they talk about rates, and we'll see whether it's a positive or a negative effect. I will say this: the markets are looking pretty strong, and everything's looking pretty positive, but I am a little bit hesitant as to really saying for sure that we're ready to move on. Based off of what I'm seeing with the U.S. dollar, we're in an interesting spot where the U.S. dollar is picking up a lot of strength as well as the stock market. Those don't typically go up together, at least not in an environment where we're expecting rate cuts. And it's interesting that the dollar was kind of bouncing into this anticipated announcement of a rate cut. Now, it may not happen. We might not cut the rates yet. If we don't, I imagine that's probably bad news since people are expecting it. If we do cut rates, then it should be good news, and we should rally off of it again, unless they decide this is going to be it and that they're planning on reevaluating whether they want to raise rates after. So a lot's going to be based off of the language of the report and what they say. As is typical during an FOMC Wednesday, be wary of the first move. Typically, the best thing to do if you are a swing trader is wait until today. It's today around the close, and maybe even tomorrow at the open, until we have a better opportunity to digest what they say, and that'll give us a clear indication of what the next move in the stock market is going to be. A lot of times when you have a strongly anticipated FOMC statement, you tend to have a couple of wild swings in the afternoon. One right at 2 o'clock, and then you have a counter move, and then typically a counter move to that. And then from there, you'll find out whether that move is enough or whether we need to re-explore in another direction before we finally figure out exactly where we want to go. So keep in mind that could happen. But once we have today out of the way and we start opening tomorrow, we should have a much clearer indication as to whether we're ready to start really rallying in the market or whether we need to spend more time around our current levels or possibly even pull back and retrace further. Now, as I said before, I think everything looks pretty bullish. And if you take a look at the S&P 500 right here, you can see this is a pretty bullish chart, and I think a lot has to be done before I would say that the chart starts to look negative. Even if we do pull back and the market's not happy with the Fed's language today, we have some room to pull back and not really worry too much about where the market is. As you can see, we were rising steadily, and we formed this rising wedge, which typically is not that bullish of a pattern. You usually expect a stronger retracement from it than what we saw so far. We basically just had a 2-day drop sandwich with a bounce, and eventually kind of made our way higher and are now trading again at all-time highs, or very near all-time highs. We printed all-time highs a few days ago. And overall, we're just printing a bull flag. If you really want to sit back and take a look at this, all we're doing is consolidating almost in an exact sideways manner after our last move up, right? So we rallied all the way from 280 up to about 300, and we've just been trading sideways, printing a bull flag. This is all very bullish. You can see volume has slowly declined during this time, showing that it is indeed a consolidation pattern. And typically in these situations, you resolve to the upside and continue the move, right? So this right here, to me, looks bullish. Now, the one negative, of course, is that we did have this rising wedge showing that momentum was fading a bit. We did have a little bit of spike in volume as we started to fall out of it. But again, there's so much demand in the market right now that we just immediately bought up the supply that started to show up and have pushed the market right back to new highs. Now, If we do pull back, if for whatever reason we're not happy with what the FOMC statement is, or with what their decision is as far as moving forward, well, we now have plenty of room to come back and still be in a pretty bullish stance, right? We've held above the 20-period moving average. You can see the 50 moving average starting to curl upwards, indicating a nice trend that is beginning to continue upwards. And as long as we don't fall below 291 to 290, then I think things are very bullish, particularly in the short term. If we go ahead and take a look at a weekly chart, and those of you that are regulars have seen this chart often, you can see the range that we traded in over the last couple of years, and you can see how we're trading well above it, right? So if we do pull back, as long as we stay above our previous range, then things are still golden. We're still looking really good, and we're still looking like we want to continue rallying. And what we're actually doing is something very analogous to what we did a few years ago before the election rally in 2017. You can see we rallied for a while, and then we traded sideways from about 2015 to the middle to end of 2016, and then we broke out and printed new highs. And as you can see, we consolidated above the previous range, and that eventually confirmed enough support for the market to decide it was ready to rally, and we had that big run up. It started in 2017 and ran all the way up to the beginning of 2018. And once we hit these highs around 285 to 290, we started to really find a lot of supply and a lot of resistance that we couldn't push through. And we've spent the last couple of years trading in this wide range as we've explored this new area between about 290 and about 255 or so. Now, we did have a couple of attempts breaking higher and a couple of attempts breaking lower, but we've, to the moment at least, resolved enough of the range to trade back above it and are attempting to hold above it. Now, just because we're trading above it now doesn't mean that we have a completely confirmed breakout and that we're ready to rally higher. As you can see, at the end of last year, we had a pretty strong confirmation of a break below, and we're looking like we had found maybe a market top. Now, of course, we started this year in an incredibly strong mode and really didn't take our foot off the gas pedal until a couple of months ago, and really just zoomed right across that entire range and now right back to the other side. And as you can see, very similar to what we had the last time. You have a move up to the top of the range, right? The first exploration of it, then you come back and retest it, the bottom, come up and retest the highs, and then come back and probe a little bit lower before making our way back up. But you notice the last time we hit a resistance, you pull back and only explore maybe the upper half of that range and then try to make our way higher. And that's exactly what we did again. We had a probe lower, then we came up, tested the highs, and then the last retracement was only about halfway, not even halfway of the range, and then came up and started printing new highs. So very, very similar pattern to what we saw before, and as you can see, that eventually resolved in a very strong move to the upside. And that's really what we're setting up for right now. And so as long as we stay above this 291, 290 range, then we're almost broadcasting that we're ready to move on past this range and move higher. And that's a very, very strong pattern. And it's one that it's replicated across all kinds of equities. And if you're someone that has trouble trading, this is one of the things that you should always look for. Is you look for stocks that have made these big bases. These, just draw a rectangle, and if it holds the entire range, then you can see that it's traded in this big base. And once it moves past it, you just wait for the confirmation that it's holding above it, and then you buy that, and that becomes your new floor. And you have a trade that you can trade off of strength while still using some value-based risk-reward based off of the new level of support. So that's what we're kind of hoping for here, is if we do pull back, as long as we hold above 290 to 291, that should now become our new floor and the new perception of value for the S&P 500, and particularly for the SPY ETF. Now, if we do lose that, it's negative. I'm not gonna, there's no way of kind of playing around it and saying that that's still positive. I think it's definitely a negative. If we lose 290, we fall back into the range. But I think in the intermediate to long term, it's not a true negative development for me until we start to lose this area here around 281 to 273 or so. That's kind of a broad range, but to me, this is the line in the sand. Really, is this 280 to 281. I think if we lose that, then we're likely going to test the 200 and a little bit below that. So this is kind of the line I don't want to lose. If we lose that, then I think that we're going backwards for sure. And at that point, I would say that we are more likely than not going to continue to stay range bound. I'm not going to say that that's indicative of a market top. I think we need a lot of backwards action before we have to worry about a market top or about a bear market. But I would not be happy with a move back below 280. I don't think anybody would, as that would definitely indicate that we are not ready to rally forward and instead are still mired in this range that we've spent the last couple of years in. And truth be told, if we lose that line, there's a decent chance that we have to come back and explore all the way to the bottom of the range. So we don't really want to see that. We'd like to see us hold above, and more likely than not above this 290 area. I think if we hold above that, then again, I think it's indicating that we are setting up for a strong rally, not just a typical little bounce, a strong rally like we saw in 2017, or even the ones we saw in 2012 to 2013 and 2014. And if that's the case, then we can expect some nice moves and some nice continuation trades as we take advantage of the upwards momentum. Now, that's not really where we are yet. I think we still need to wait for complete confirmation of this zone, but that's what we're hoping for, and that's what I'm looking at and kind of anticipating as our next move. Now, I know that the tone overall, if you watch social media or the news, is that they're not quite that bullish yet, and they're expecting a bit of a pullback, or they're expecting us to stall out. But if we hold above these technical levels, then I don't think there's anything holding us from a strong move. Now, we have moved beyond. We have moved beyond most of earnings season. No audio or video. Ray, I think it's your internet. It's showing fine on my extra screen, showing that it's broadcasting. So it might be an issue with your internet. You might want to reload it. Regardless, if anyone else is having trouble on here, type it in the chat. Let me know if you're having trouble seeing the video or if it's working fine for you. Either way, I will have a recording of this on my Patreon page later. You can always go back and review it. Now, what I was about to say was we have seen most of the major reports. With Apple reporting yesterday, we now have all of the FANG stocks are done reporting earnings. Now, we still have a pretty heavy week as far as what's reporting today and tomorrow. But once we finish this week, we'll still have earnings reports coming. But a lot of the major reports have now reported, and as you can see, they didn't really make a dent in the market, right? So we had some good reports and some bad reports, but overall it was a nice healthy mix, not indicating one direction or the other. And the market has kind of digested it finally and not really had any worry about that. So it looks like for the moment what we're waiting for is to see what happens with the FOMC and see where it goes from there. Thank you, Texas Landlord. Glad to see it's fine with you. By the way, Texas Landlord, you had asked me a couple of weeks ago, but I had logged out when you had asked. But you were asking about Frank. And just to give an update, I'm not sure if you've heard, but Frank apparently was trading a lot of people's money, and he disappeared with it and has not come back. And if you are someone that gave him money to trade and you haven't heard and you're wondering what happened, feel free to email me after, and I'll give you a more concise update or a more detailed update as to what's going on with him. But for the moment, it appears that he basically defrauded a lot of people out of money, and I haven't heard anything to counteract that or to say differently. So that's what we're going off of right now. Now, as far as where we were with the markets, I think, again, it depends on what we do with FOMC, but overall, we're looking pretty strongly, and until I see a change in character and I see us start to fall below some of these key ranges, I'm going to be playing as if we are rallying, as if we're ready to move forward strongly. Now, that doesn't mean that we should chase price action at highs. Now, that's the one issue I really have right now. If you take a look at the S&P 500 here, this is not, while this is pretty strong, it's not a pattern that's that easy to trade right now. Yes, we have a bit of a bull flag, and we can trade the bull flag, the breakout of the bull flag. But what I'd really prefer is a little bit of a stronger consolidation range that gives us a better risk reward or better value. Now, I'm going to go ahead. By the way, just to make sure, I'm going to type out my email for you. Obviously, I just typed it out so that some of these bots on the internet won't just go ahead and type it out, but you can figure it out from that. So I lost my train of thought here, but as far as oh yeah, so risk reward. So just because the market's not having great risk reward doesn't mean that we can't find charts with good risk reward. As a matter of fact, that's been one of the things that I've worked on this week, is making sure that I find charts that are trading at spots where we can find better risk reward than what we're finding in the overall market. But overall, my focus is bullish, and my focus is on trading to the long side, and I think that should be the case for a while now. I think a lot of times traders get a little cute with what we're seeing here, and they try to short just because they think the market's too high. And the truth is that the market can continue rallying higher, and even if we do drop, it could be a situation like this rising wedge, which I had actually warned about when we were printing the rising wedge, which is, even though this is a pattern that usually resolves to the downside, there's so much pent-up demand waiting that it feels like it's missing this, that it becomes a very difficult trade. And that's what ended up happening. As we broke out of that wedge, there were so many buyers waiting to step right back in that it didn't even drop. It just continued to climb higher. So at the moment, I would say try to refrain from looking at short trades. I found a few trades that look nice to me as far as shorts are concerned, and it looks like they look tempting, but I'm avoiding it because the overall current right now in the market is higher, and there will be pockets of demand that step up even when we're expecting the market to pull back. And at the moment, like I said, even if we do pull back, we're just pulling back to support as far as I'm concerned, and there's a very good chance that we actually try to rally from here. Now, if we take a look at the NASDAQ, you'll notice again, almost the same exact pattern as the S&P 500, right? We had that rising wedge. We had a fall below it that spent maybe a day or two, and then we've been printing a bull flag. Now again, this is sort of a rising triangle. It could even be considered just a continuation of this rising wedge a little bit below it. But for the most part, if we get rid of this wedge, well, we have another. We can also say we've just been trading along this, right? Just a nice little channel to the upside. Or we could say that we had a move up and we have now decided to flag off of that. As you can see, by the way, it's one of the things with technical analysis. Some of it is up to interpretation. And I think what you have to understand when you see this, I think a lot of times traders will look at this and they'll say, well, he's just trying to fit the lines. Particularly people that don't believe in technical analysis, they'll say, well, he's just trying to fit the lines in a way that makes sense. And what you have to understand is that each of these trend lines represents what people think about the market, right? This right here, this channel represents sort of an intermediate term sentiment, what traders have thought about the market since June. And this horizontal trend line right here at the highs indicates people's attitude or traders' attitudes about what they consider to be a price that's too high for the NASDAQ, right? So when I'm drawing these lines, it looks like I'm just connecting dots on a chart, but what I'm really doing is giving you guys a visualization of what traders are thinking about the market, right? So because of that, sometimes there will be sort of murky pictures where we're not really sure, because let's face it, there's a lot of people trading the market, there's a lot of eyes on it, and not everyone's going to think the same thing. So it's up to us to kind of get a view of what we think is happening and try to understand that there will be conflicting points of view. And what we have to do is not try to predict what they're going to think next, but come up with a scenario where once it happens, we understand why it happened, and we have our play set in place to take advantage of whatever that is, right? So in this scenario, we can look at it in two ways. We could say, well, the market's been kind of climbing steadily higher, and it's reached a point where it's really struggling to push past 195 on the Qs, and we're starting to lose momentum. Again, you can see volume declining as we've climbed higher, which is again a sign of waning momentum. So a trader could look at this and analyze this and say, well, we're losing momentum. Likely, we're going to have a drop because the market can't continue to climb at this pace with buying, with all the demand kind of drying up. Now, someone else could look at this and say, well, we had a strong move up, and at the moment we're just consolidating sideways because we did find a wall of resistance, but there's enough buyers that continue to buy immediately and continue to support the market even as it's starting to get tired out. And what they're waiting for is for the new buyers to step in and push it past that, right? And I think both points of view are perfectly valid. Because that's what's happening here. We're having a conflict between two overwhelming sentiments. One that thinks the market's going higher, one that thinks the market's overpriced. and what we need is an imbalance where one side ends up outnumbering the other, and that's when we get either the push higher or the move back down. And so, keep that in mind when you're analyzing something with trend lines or with technical analysis, is that there's always two sides to a coin, and there's always going to be two views of what the market is doing. And it's up to us to understand that there will be sometimes conflicting points of view, and what we want to do is not necessarily predict it, but have a plan in place in case either scenario occurs, right? So in this case, if we end up losing momentum, then like I said before with the S&P 500, the key is that we stay above our previous range, right? So again, if we go back to the weekly chart and we look at what's happening here, you can see we've traded in a broad range on the NASDAQ, again, since about the middle of 2017 on to this year. Now, the NASDAQ did slowly continue to build new highs, and really the top of the range wasn't explored until 2018. But overall, it was basically the same thing. The markets were trading sideways, and the NASDAQ was, for the most part, trading in a sideways manner as well. And we've kind of pushed past that. And the big thing, again, is that we stay above this range around 185 to 184. And if we can do that, then again, we're confirming that we are ready to push past this previous range and continue higher. Now, if we fall below that, a lot like the S&P 500, there's this line in the sand here, which again, the reason this horizontal line is here is not only was it a previous level of importance, but it also coincides with a break of this retracement that we had. The retracement that if you remember when I mentioned earlier that we moved from the lows of the range to the highs, and then when we hit the highs and we retrace, we only retraced a portion of the total range and then moved higher, right? So this was a big turn where instead of doing like we had over the last couple of years where every time we hit highs we have to go back and explore the bottom of the range, this time we only explored halfway and then eventually found enough buyers to push past the new highs. So this was a big change in character where the market was indicating that it's done with exploring the bottom of the range, and really what it wants to do now is make sure that it's ready to push past the top of the range, right? So as long as we hold above that, then we have to assume that the market is done testing the lows of its range. But if we lose this breakout, if we start to go back into this and challenge this retracement again, then that means the market is probably not ready to push past this range, and means it might need to come back and test the bottom. So that really is the line in the sand. And while we want it to not lose 187, really the key in the long-term picture is to not lose this 178 to 175 or so, just anything in that range there. If we do lose that, then I think that's when we realize that there might be more trouble in the markets than expected. But ideally, if we do pull back, we hold above 187 and build up a nice support zone here, and then eventually take off and start rallying into the end of the year, and hopefully rallying very strongly. Other than that, everything else is pretty much identical to what we're seeing in the S&P 500, and I don't think there's really anything else that I haven't said already for the S&P 500. It doesn't also hold true for the NASDAQ. Now, if we look at the the Dow Jones, you'll see again a slightly different picture, but still very similar. You'll notice with the Dow Jones, that rising wedge that we were forming, it actually broke above it, and I think this one has the clearest bull flag of any of the indices, right? You can see it very clearly where you have this kind of climb higher, then you break out, and then you trade sideways and build up momentum to try to break out past that, right? So I think this is the clearest bull flag, and again, it looks very bullish. Nothing here, nothing at all looks negative, and that's the thing that's interesting, is that as we approach FOMC, everything here looks very bullish. And the first three indices that we've looked at are all broadcasting bullish moves. Of course, news can change things, at least in the short term, and that's what we really are concerned with right now, is what our reaction is going to be once the statement comes out, and what happens finally with the rates. But overall, these patterns are all very bullish, and as long as they resolve in the right direction, then we will continue to kind of move higher. Now with the Dow Jones again, it's very similar. We've got the 50-period moving average climbing higher, and if we do lose this range, again, you could look at this and say, well, we've had this sort of upwards trajectory for a while now, and if we lose that trajectory, then, and again, look at the volume. drying up as we kind of continue to climb higher. If we do lose this range and we pull back, I think as long as we hold above 264, 265, we're still in the same place. We're just coming back and retesting and confirming this, and I would not, in the very least, be concerned about a pullback, even if we dropped all the way from 272 to 265 in a couple of days. I still would not be too worried about it. We have the 50-period moving average again rising up to meet price, and if we confirm and find support here, well, then we're setting up and we're doing exactly what we did 3-4 years ago, and setting up for a move higher once we confirm our breakout of the previous range. And again, that's really the key here, is as long as we stay above the previous range, things are positive, regardless of what happens in the short term. Now, if we do lose that range, then again, very similar to the last two charts, well, we have to come all the way down here to 255 or so, the 200-period moving average, and the break of this recent retracement, and that becomes the line in the sand again. That is what if you're worried about the market, this is where you should worry about it, is when we get to that point. As long as we're above that, I think long term you shouldn't worry too much about what's happening in the market. Now short term, if we lose to 265, then yeah, that means that we're going to spend a lot more time chopping sideways, and that might not be good for what you want to do as far as trading is concerned. But as far as the overall health of the market, I don't think losing this level is too critical. Although again, I don't want to see it. I want to see us find support here and then immediately take off, because that would be the most bullish scenario, and that'd be the scenario that would most likely lead to a strong rally to the upside. If we continue to mess around here, 265, 264, drop a little and come back up, then that might indicate that we need to spend a few more months consolidating and testing this range before we're really ready to move past it. And again, if we dip below that, it could still mean the same thing, but then we have to start to worry a little bit more and keep a closer eye on what's happening with the price action. Now, interestingly enough, of course, the one index that's completely different is the Russell 2000, and as we look at IWM, you can see that it clearly is nothing like any of the other indices. We're nowhere near all-time highs. We're nowhere near the top of our previous range. And matter of fact, we couldn't even maintain that upwards trajectory that the other indices all have maintained over the course of the last couple of months. Now, that being said, we have had a very nice bullish turn of events over the last 2 or 3 days. You can see a lot of momentum and a lot of volume kicking in here, or a lot of volatility kicking in. As far as this back and forth movement, as we've attempted to push past 156, and really the key here is what we're trying to do today, which is break past this 158 range, which, as I mentioned last week, is pretty important. We go back and take a look at what happened in May. We had a really strong breakout. These 2 days, these two strong green candles, right, showing that there was a lot of bullish momentum coming into the IWM, into the small cap, showing that traders were willing to accept some risk. This was a nice looking move that looked like it was indicating that we were ready to rally in the markets. Now, obviously that failed. It failed pretty spectacularly the next day, and eventually came all the way down and tested the bottom of its range. And since then, IWM has been pretty weak as it slowly climbed its way back above its moving averages and made its way back to this scene. Now, we're back. We tried to break out. You can see already we found a little bit of selling and kind of fell back into this range. This is critical. If we could break past this, if the FOMC statement is construed as a positive move for the markets and everyone wants to kind of buy and we want to rally, then we're going to have to see IWM break past this and start to play catch-up and start to fill in this area between 158 and 172. As you can see, again, we go to the weekly chart, you can see there's a lot of room here. There's a lot of room to explore to reach the top of that range, and before we reach all-time highs on this, we have to kind of play catch-up and go through all that. Now, can we rally without IWM printing new highs? Yes, we can. We've done it in the past. You can see IWM again was not quite the same as the other indices when we've traded between 2014 to 2017, but at the very end it did do the same thing. It broke out, held above the previous range, and then eventually that's what led to the nice rally. But you can see even when it did break out and hold, it did have a temporary breakdown, a false breakdown before it really shot up higher. So we can't really trust what IWM is doing at the moment, but what I do want to see is I want to see it play catch-up, and I want to see it at least not be trading at lows while the other markets are moving higher. Because if it continues to falter here and trade below 158 and can't break that level, then I think that's a pretty good indicator that the rest of the markets aren't really ready to move past that range. And that again would likely mean that we're going to stay range bound in the overall markets. And what we'd see across the board is, instead of breaking to new highs, we're probably going to have to pull back and retest our previous level, the previous high of the range, and kind of go back and forth and really wait for IWM to get its act together and at least reach the upper half of that previous range. And I think that's really the issue here. Now, one thing I will point out is I'm not overly concerned with what IWM does as far as if it continues to falter here. I think what we see out of the other three indices is more important right now. And I think the key is, as long as IWM doesn't lose this big range of consolidation we've been in, this 153 to 157 or so, as long as we don't fall below that, I think we're okay. And if we do fall below that, obviously the key is we don't want to lose 145. I think if we lose 145, that's a really big negative. That likely would indicate that the other indices are all challenging the line in the sand that I pointed out from before and are likely going to fail that. At which point we would have to definitely step back and reevaluate the markets. Now, again, I'm not expecting that right now, but it is something to keep an eye on, and you always want to be prepared and ready in case something like that happens. But for the moment, I'm expecting us to try to push past this range and try to move forward and move higher into the rest of this summer and into the fall. All right, so that's the four major markets. Again, everything looks really bullish. The one caveat, of course, is that this could change. The picture could change drastically based off of what we see with today's FOMC report. But I'm expecting it to be, received at least okay, if not very well. And if we don't rally strongly off of this, then I expect us to probably come back and test some of these initial areas of support and just kind of consolidate in a bullish manner. I'm not expecting a real negative turn of events here. I think even if we do pull back, as long as we pull back to that initial level, we should be fine. As long as we hold above the range that we've spent the last couple of years in across the board, then I think overall we're in a very bullish state and are setting up for a strong rally. And we should be looking at playing to the long side as long as we find good risk reward in the setups that we find. Okay. Now, let's take a quick look at the US dollar, see what it's doing. And here's the one interesting thing to me is the US dollar is rallying into a likely rate cut, which is kind of odd because typically that would be sort of a negative on it, right? And it's just kind of running up like if it doesn't even matter. I'm not really sure what to make of this. I'm not sure if this means that they're going to cut rates less than expected, or if this means that they only plan on cutting the rates once and then being done with that. And at the moment, it's very tricky to see what's going to happen. Now, typically, trading the U.S. dollar before before FOMC is not really a good idea because, currencies fluctuate quite a bit based off interest rates. So, not much I could do off of this, but I do want to point out that at the moment, things are a little bit odd with the market running up, with the U.S. dollar running up, and with gold and silver holding up very strongly as well. You don't normally see these equities all moving together. More often than not, when the U.S. dollar rises, gold and silver drop. A lot of times when the U.S. dollar rises, even the market drops a bit because, again, it's priced in U.S. dollars, so there's a bit of an inverse correlation there. And that's not what we're seeing right now. What we're seeing is all of them kind of moving upwards. You can see the U.S. dollar printing new highs on the UUP index and is really ramping up pretty strongly. And I want to see what happens after FOMC and see whether it maintains its strength. But at the moment, it has now kind of formed a new level here. I don't know what happened to my trend line there. Right, so we've got a new level here that should now act as a floor once we come back and retest it. So just like the markets, we're holding above previous highs, and now a pullback to this should act as support, which again is a little odd based off of the language we're seeing out of the Fed. But that's what it's doing, and again, it's very strong. We had a strong channel and a strong rally up to these levels. We eventually downshifted, but again, that ended up being a pretty bullish move as we slowly climbed our way higher, and at this point, again, have printed new highs. So this is bullish for the U.S. dollar. However you want to analyze it, however you want to point out what's happening with FOMC, at the moment the chart is indicating a bullish move. Now this could be because of weakness in other currencies, or it could be something with the U.S. dollar that we're not seeing yet, but that's really the case. Now if we look at the euro-U.S. dollar, the euro has continued to flounder again. It had a nice change here where it started to make its way up. If you just step back and look at what's happened here, the euro was really struggling with this 113 to 114 area, and eventually entered a pretty strong downtrend in the intermediate term, right? And you can see every time it tried to break that red trend line, it failed and gave nice short trades. But eventually it found good support and was able to break through. And this looked like it was finally a change in character where the U.S. dollar was going to weaken and the euro was going to finally start to gain a little bit of strength. But that strength ended up being kind of short-lived, and it's pulled back now. And it is kind of desperately trying to hold support here around 111. If it loses this level, it's going to be a quick move down, probably to 110 at the least, and possibly all the way down to even like 108. So overall, this again is still pretty bullish for the U.S. dollar and negative for the euro. Now keep in mind again, this is based off of this chart is priced in euros, so down is good for the dollar and up is good for the euro. And as you can see, the U.S. dollar has continued to pick up strength and is putting a lot of pressure on the euro right now. And we have a situation here that needs to be resolved soon, whether the euro is going to continue breaking down or whether it's going to attempt to break this new downtrend that again is starting to develop here. And so we're going to have to see whether the euro can pick up enough strength to break past this or eventually break down and start printing new lows. Now, if we look at the U.S. dollar versus the Canadian, again, the U.S. dollar, and we saw this last week, was broadcasting this potential strength coming in as it was able to break out. And as you can see, it held up pretty nicely. And despite the fact that we printed new highs on the UUP index, the U.S. dollar pulled back a bit today versus the Canadian. But overall, it's still holding in a pretty bullish stance and is still kind of attempting to find a bottom here and make its way back up to the 132, 133 area. And I think overall, again, this is still neutral to bullish. It's definitely, it looks like it found the bottom and is trying to make its way higher. And again, this could change drastically based off of FOMC, but I think overall, again, this is showing and indicating that the U.S. dollar is finding some strength now as opposed to the weakness that we saw through May, June, and July. And then finally, the other cross we like to look at is the U.S. versus the yen. And this one, again, is looking a little bit bullish. Now, interestingly enough, we're again not seeing really, we're not seeing something that reflects what we're seeing on the UUP index. This is still, the UUP index is at highs, and while the U.S. dollar was about the same place versus the euro, it's not in the same place against the Canadian dollar or the Japanese yen. And as you can see, it's kind of attempting to consolidate here and really, same as the Canadian dollar, find a bottom and kind of break this bearish trend. And we're kind of neutral now. And what we want to do next is it wants to sort of prove that this neutral trend is going to turn into a bottom and then turn into an uptrend. And it's been slowly breaking past 108. If it can break past that, well, then it should move to 109.2 to 109.5 and then possibly even further. But overall, I think it still has some work to be done versus the yen. And we'll see where it goes from there. But I think overall, what I'm seeing here is a mixed bag. And I'm kind of vexed a bit as to why the UUP index is so strong. We'll see what happens after FOMC and see if these charts can get in a better place where it's a little bit easier to analyze what they're doing. Now, the interesting thing, again, as I said before, is that despite the strength in the U.S. dollar, the gold and silver are holding up very well, right? If you take a look at this, this is very strong. Now, we're not at highs yet, but we printed highs just a couple of weeks ago and are holding up very strongly and just kind of consolidating sideways. Now, again, a lot of volume came in, and gold tends to do this sometimes. When it has these strong moves, the consolidation ranges tend to be a little bit wider and tend to be filled with some volume. But overall, this is still pretty positive. It is reaching a spot where it often loses momentum when you have these kind of broad triangles, I'd say it's doing something like this, right? And as you can see, it's starting to really test this ascending trend line, and there's a decent chance that it's going to lose its 20 and have to come back and retest around 130, retest this gap, retest the 50 pair moving average. But as I said before, a lot depends on what happens with the U.S. dollar and what happens with FOMC. If the U.S. dollar drops drastically based off of whatever the Fed is saying, then gold and silver are going to break out and start printing new highs. If the U.S. dollar holds up, then these will probably pull back and start to test these ranges. Now, if it does come back and start to test this gap, that's probably a decent buying opportunity. And if it breaks out, that's probably a decent buying opportunity. That you have to be a pretty good momentum trader to go ahead and try to trade this off of an FOMC move. And if we take a look at SLV, again, same thing. I think at this point, we could say that this is a bull flag. And overall, holding up very strongly, which is not what you'd expect. Again, if you just took a look at the U.S. dollar index, you would not expect gold and silver to be holding up well with this kind of a move. But it is what it is, and that's where we are. And I think at the moment, if we lose this level on SLV, then again, probably we'd want to be looking at 15 or so as the range where it comes down to support. We don't really want to see it fall too back below. You can see it's well above its 20, 50 per moving average. We had a big price explosion a couple of weeks ago, and it still has a long way to go before those moving averages catch up to price. But overall, this is, again, very positive and looking pretty strong. And finally, we have oil, also moving strongly and breaking out, although it has been weak recently. You can see it finally did find some support at 54 to 55. It finally broke this descending trend line, indicating this bearish sentiment that creeped up on it from April to now. And I would say at this point, we had one attempt to break that failed, and this second attempt I think should hold. So I think this is probably a bullish change in oil. You can see all the moving averages clumped up together and starting to turn upward slowly. This is typically a good indicator of an incoming trend change. And I'd expect oil to rally here, and I'd expect oil to be strong. So it might be a good idea to start looking at oil-related names. It's not completely out of the woods yet, but I think at this point, when we get a nice consolidation range, the next move should be up on oil. So this is an area we could focus on, is names that correlate well with crude moves, and that would move with it. But I'd say overall, this is starting to look like a nice attempt at a trend change. It's, like I said, it's not fully done yet, but I would expect the next consolidation to be one that would be worth buying and worth trading to the upside. All right, so that covers oil, gold, silver. Like I said before, a lot depends on what happens with FOMC today, particularly for the U.S. dollar and for anything that's affected by the U.S. dollar. Obviously, the markets have been waiting for rate cuts. We'll see what ends up happening and whether we do get it, and if we do, the character of their language as far as what we're going to do moving forward. We have a good 15 minutes or so. Those of you that are in here, if you have a chart request, feel free to type it into the chat. I'd love to see what you guys are looking at, and see if I can help you find a chart that you, it could be anything. It could be a chart that you're already in. You don't know what the levels are, whether you should take profits or whether you should stop out, or maybe it's a pattern you have a question about, anything like that. Feel free to type in a ticker, and I'll let you know my thoughts on that particular chart. While I wait for you guys, I'll point out Apple. Apple reported earnings yesterday, and it was a good report, but you can see it's faded almost completely. It's still okay for now, but this shooting star is not a positive sign as far as continuation upwards. Looks like, if anything, Apple's going to probably have to spend the next few weeks either filling this gap or trading in a range around today's candle. Clearly not the most bullish of candles at the moment, but we still have the rest of today and see how it fills it out. Now, interestingly enough, I want to go back and look at the FANG stocks while I wait. Again, if you guys have, I'd love to see what you guys are looking at. So those of you that are in here, feel free to put in a chart for me. You look at Facebook. Facebook had earnings a couple of weeks ago. They've done okay. You can see just like Apple, they struggled to move higher, but they've held up well. and are now beginning to find some support around their previous highs, right? So if you take a look at this, you can see overall what's happening here, and this is almost it's almost like it's doing what the market has already done, where it broke out to new highs, and then what we're anticipating is that it needs to come back and retest the previous highs. It's almost like Facebook is a little bit in front of it, although in reality it's because it's lagging. But Facebook is kind of testing the previous range and trying to hold above it right now. And with today's candle, it's attempting to confirm support here. I don't think it's fully done yet, but this is what it's trying to do, and it looks okay here. We look at Amazon. Amazon, again, a little bit weaker off of their earnings report, and you can see they're testing their 50-period moving average. They're a bit below the previous range, analogous to what we saw on Facebook. So this is showing a bit of weakness. You can see we're at the 50 period. A lot of times what happens when you lose the 20s, you come back and test the 50 and then come back up. So I expect a bounce here to test this in 1957, 1958, but we'll see what happens as it hits that range. It would need probably broad strength in the markets to be able to break past this and start climbing higher, but overall I'd say this is a little bit more of a bearish chart compared to what we saw out of Facebook and compared to what we saw out of Apple. If we look at Netflix, again, not a good chart for the moment in the short term. We had the very poor earnings gap. I mentioned last week and the week prior to that there was a decent chance for Netflix to bounce here, but it would find some strong resistance here around 340. You can see exactly it found it at exactly the bottom of its previous range, and that was kind of like a wall. And I think again, what's likely to happen now is that it's going to continue this trajectory. It may not be exactly like this. It might be like this, but it's going to try again for that level, and it's probably going to have to test this level 2 or 3 times before it either breaks it or eventually rolls over and comes back and starts testing lower. Now, this again, a lot like Amazon, these charts aren't necessarily, they're not indicating that the market's ready to push to new highs, because the FANG stocks aren't leading the way higher. So this could be something that we need to pay attention to, is how these stocks react as they challenge these levels, because typically the FANG stocks are the ones that lead the market higher, or at least are bellwethers telling us what the market's doing. And at the moment, a few of them are not really in the best place in the world. And if we look at Google is doing nicely. This one, like Apple, had a good report and it gapped higher. Now you can see again, just like Apple, there's a lot of selling pressure once it did gap up, right? Look at that big long wick. And it's doing something very similar to what I expect Apple to do, which is to hover around that gap for a while and probably trade sideways as it tests some of these previous ranges. Now again, that move was all the way back up to a previous gap down it had on its last earnings, or a couple earnings ago. And overall it's pretty strong. It's not like the markets, but I think what it wants to do now is try to explore this area a little bit further and eventually push past it. I think the interesting thing to point out, again, like I said, is that the FANG stocks aren't mimicking the market right now, and the market's not mimicking the FANG stocks. Now, whether that's good or bad, I can't really tell you for sure. I think it's probably good that the markets are ready to move on even without these. But we'll see whether these names end up kind of dragging the market a bit. Now, I will say this: all of them have reported earnings now, and none of them had an adverse effect on the overall market direction. So again, I'd say that more likely than not, the market can move and will move without them, and kind of bring them with it. But we'll see what ends up happening. Again, as far as whatever happens with FOMC today, I think that's really the big key. All right, well, that should cover it for today. Again, I think we're still having some issues with Ticker TV as far as people able to chat. I might have to look at switching to a different streaming service. If you guys have if anyone in here wanted a type of question but they couldn't because they're not they're not part of they're not Ticker TV members, or for whatever reason they're having trouble with the internet or anything, you can always ask me on Twitter. Like I said before, I showed my name on Twitter, stockdarts. You can find me on Discord as well, or you can email me. I type my email there, and I will be more than happy to answer any questions or any chart requests you guys have. Other than that, hope you guys have a good rest of today, and we will meet again next Wednesday.